Hello and welcome to FTSE Funds and Finance, the Straight Talking podcast brought to you by Goodwin Financial Services. I'm joined once again by Steve Goodwin and Josh Goodwin in a very cold studio. That's why we're in our coats. Good morning, gentlemen. How are we doing?
Very, very cold.
A little bit under the weather, but all right.
Yeah, you're under the weather. You mocked us a couple of weeks ago when we wasn't feeling very well.
Yeah, it's come back to bite me now.
So we've got a bit of a shorter podcast today, just to bring a few things. Number one, Josh, I know there's something that you want to talk about. Tracker rate mortgages. You just got some advice for people.
Anyone on tracker rate mortgages, need to review them. There's some really competitive tracker rates out there at the moment. The ones you maybe or might be a bit more expensive might be able to reduce costs for you potentially. So it's for the sake of an email or a course, definitely well worth looking into.
I think, could I just chip in there? I think one Josh did last week saved the client around about £4,000, and they literally didn't have to hardly do anything, but just by a manoeuvre could save nearly £4,000.
And that is something can do. We can all get a little bit complacent with these kind of things, can't we? And sit on it and not do it. But it's important to save the money. The best you can is to get it reviewed. So if you are on a track rate mortgage, get in contact with one of the advisors, Josh, etc., in the office. Moving on to the financial news, there's been a little bit happening in the US market, Steve. Little bits of rumblings come about. Your friend Jerome Powell as well has been out saying some stuff. Do you want to just bring us the update of what's happening in the markets lately?
Yeah, so we're recording this on the morning of when the Bank of England are going to announce the UK interest rate, which I'm expecting to be 0.5%, but I'm saying that before, so if it comes out higher or lower, then that is different to what is expected. In America this week, we've had the inflation data. We also had the UK inflation data. The UK inflation data was down 0.4%, so moving in the direction that I expected. And the US inflation data was much, much better than anybody expected. And on the back of the US inflation data, everybody in America got excited and markets went right on an upswing. And then the American Central Bank announced a 0.5% rise in their interest rates, which again is the most favourable expected. So once again, things have happened and markets start to kick on. But then Jerome Powell comes out and with words decimates all the growth that happened. And his words were, "It will take substantially more evidence to give confidence that inflation is on a sustained downward path." Now, all he's doing is suppressing the market going up. And there is a theory from some economists that what Powell is doing, he doesn't want markets to go up because by markets going up, it creates more money in the economy and helps to create inflation. So to continually spout this stuff is all about containing market rises. And if you buy into that theory, then this all makes a lot of sense as to what is going on.
So just trying to keep the inflation. Is that the right tactic from Jerome Powell to downplay it at this point, to try and keep the inflation down? As we've talked about before, inflation is the erosion of wealth. Is it still the major factor they're tackling at the moment?
Well, as you know, I feel that the banks are way overreacting to the issue. And as I said to you just off air, it's like somebody getting a common cold and you're being prescribed chemotherapy. I mean, you don't need chemotherapy for a common cold. You need some medicine, but you don't need that sort of medicine. And my view is that that's not to that extreme, but that's what's going on. And I don't feel that, I think inflation will come down naturally. It doesn't need this big the intervention as severe as it is, but this is what they're doing. And it's stopping markets rising to the levels that they naturally want to rise to. And we're going to come on to that in a minute. But people are listening to words rather than just watching the data. And to me, you should watch the data rather than listen to the words.
And I suppose, again, that's another reason to have a strategic investment plan, to have goals, long-term goals, is, helps you combat these kind of ups and downs and that in the market. With the UK economy, it grew a little bit in the last quarter, so we haven't dipped into a recession as of yet. Is that expected? This shows that Sunak's policies are working, Josh, or is it what we expected, or do we expect we'll just prolonging the inevitable?
It's what they call the technical recession. I think there's an argument that we're in some form of recession anyway, with the high inflation, a lot of job pressures in certain industries. So there's a very, very valid argument that we're in recession all but name. So.
And Steve, the same for you in terms of the economy growing a little bit. I mean, do we expect that, or is it just
Yeah, I did expect that. I mean, what you're getting at the moment, though, and I don't want to get into a political debate of whether they're right or wrong. I try and avoid it, but the unions, the union behaviour, and what they're playing at, and whatever view you take, I know you're going to have people on two sides of the argument here, but that is not helping our recessionary situation. It's causing a lot of damage, and that will damage the UK economy more than anywhere else in the short to medium term. So America doesn't have the strike problem, but the UK has got it in every shape and form. And that is going to cause a lot of damage that has not really been thought of before. That's on top of what we already have. So temporarily, the UK is going to be in a worse place than everywhere else.
Yeah, so we're still expecting it to not be great in the short term. I know you wanted to talk today about myth busting. I know there's something you wanted to talk about, as in a common accepted statement in financial services, and I know you wanted to talk a little bit about that to dispel that myth a little bit. So I don't know if I want to hand it over to you.
So the bottom line is, I speak to clients all the time, and I've been doing this now for 30 odd years, and it's probably the same discussion now as I've had over 30 years with many people, and the common behaviour of a person is they don't want to buy until there is clarity in the market. Mm-hmm. They want to buy when the inflation is under control. Everything is looking rosy in the garden. Employment is at maximum. But that is totally and utterly the wrong thing to do. If you have calmness and clarity, what you have are expensive to buy assets. And it's very risky because you're buying at a time when everybody knows it's good. It's totally the wrong strategy. Now, if you look at stock markets, when you have a fall, there are three different stock market rebounds. One is V, which is literally like that, and that happened in COVID. You have a W, where you have a double dip fall. And then you have a U, which is a longer term recovery. But if you look at all of those, when you come off the bottom, the actual recovery is huge. In the first few weeks, you get massive surges, like we actually had from October. And it's huge. So if you're waiting for the clear indicators, you're going to miss the big upside. And the other thing that is historical and is happening today is that when the bull market begins, people become more pessimistic. Now, in my newsletter to my clients this week, I'm going to be sending out a chart which shows you the COVID recovery and what the so-called experts were saying while it was booming up. And if you listen to those experts, you'd have missed the really big recovery. Clear signals do not come when you're at the bottom. They don't. They really don't. And people are sitting out there, and I know with money in the bank thinking, I'm going to invest when I get clear signals, but that's going to cost you a lot of money. And COVID was the thing. If you take COVID, and I said to somebody now, and I say to all my clients, when we went into lockdown at the end of March and we're all locked down in our houses, what do you think happened in April and May? And they said, oh God, it must have fallen through the floor. But it actually didn't. We had massive growth in April, May and June. Massive. We're all locked down, but the market's moving. And that is the biggest example of why this myth is such a load of nonsense. And in fact, the further down the stock market goes, the more you should want to buy it, because you're buying assets cheaper. And to summarise, the risk is the least when the fear is the highest. It's totally illogical to try and wait for markets to stabilise before you buy, because you will miss the massive growth that there will be in an upside. And we covered a thing a few weeks ago, didn't we, where we said that over 10 years, 90% of the growth was achieved in 90 days. And that is something that, if you're sitting there, you might miss 30 of those days over a 10-year period. And so people that want to invest and have money to invest and are looking for longer term growth need to not listen, they just need to follow the trends.
And it's a good strategic thing. Just a caveat to put on there, Steve, as well. It's not just a case of just buying assets that are cheap. Obviously, you need to have a good. That's why you have a financial advisor to advise you the funds that are going to potentially return you that growth and everything else. So it's not just a case of going out and buying any old thing and throwing money at it. It's having a good strategic, good plan in place, a good investment in place. And that's the thing about having your money with a financial advisor. You get the reviews every year. You're looking at it all the time, aren't you? You're constantly reviewing it with the clients, talking to them on the phone. Looking at deposit rates as well, not discounting that sometimes you might be able to lock into a particular deposit rate or a structured product rate if you're into those type of investments that can really boost your growth. And you just need somebody there that you can talk to regularly, that you've got at the end of the phone or an email, and who are competent and they can help you for sure. Coming from, obviously I haven't been in this industry very long. It's one thing that's amazing, that the thing that's opened my eyes for the financial world is money's the one thing that connects us all, but it's probably a small portion of people that have the advice when it's the one thing. Whether you're rich or poor, whatever race, whatever nationality you are, money's the one thing that advises us, but it's probably the thing we take the least advice on over everything. Do you think that will change in the future, Josh? Do you think people will get more advice, or do you think it will go the other way?
That's a tough one. I think the access to information online gives some people the false sense of security that they're getting advice, but in reality they're getting information. Whether it's actually suitable to them is usually not. The amount of times you speak to people that have got, I've read this online, and the replies, that's just not relevant to you, or that's 10 years old, or various other reasons. So that's the danger people do is they think they're getting advice online when it's not actually tailored specific to them, and that's a big issue. So I think people will try to go more online, but I think eventually it will circle back to advisors.
That is a really good point. The information age. For instance, online, I can find a video to change the boiler in my house, but I wouldn't want to do it. I mean, I can still get the information to it. I'd still get someone that knows what they're doing to come in and do a boiler change. But with money, which is the one thing that's probably important to all of us, we tend to think we can just do it ourselves. It's a really strange thing. So that's another reason why a financial advisor is very, very important. Is there anything else to cover? I think we covered most things. Next week we're going to bring you a roundup of the year and our predictions for 2023. Once again, thank you for joining us. If you do want the guys to answer any of your questions, you've got any fears or concerns going into 2023, please get in contact, let us know, and I can put it to the guys and get them to answer your question. Gentlemen, thank you very much, and we'll catch you again next week.